Another topic of financing with receivables is sales of receivables. Receivables are valuable assets for the company, and they can be sold. And the gain or loss depends on the difference between book value and the fair value. The accounting treatment is similar to the sales of other assets. The seller or the transferor who sells the receivables will remove the receivable from the account. The sales price is the fair value of the assets acquired or the liability assumed. Then the difference between fair value and book value will be recognized as gain or losses. If fair value is greater than the book value, that will result in a gain. Otherwise, if fair value is less than book value, that will result in a loss. This is a flowchart that shows us how the sales of receivables work, or the factoring arrangement. The company who transfer the receivables or sells the receivables to a financial institution, also called factor. The financial institution will buy the receivable and pay for the company with a fee charged. Since the receivables have been transferred to the financial institution or the factor, the financial institution now is responsible for billing and collection from these receivables. Another example of sales receivable is securitization. The company created a SPE, special purpose entity. The entity buys the receivables, credit card receivables, loans from the company. Because these receivables are assets, they can generate interest as a return. So the SPE will securitize them into bonds or commercial papers and then issue them. So the SPE buy from company, pay the company. The securitization actually is sell to the investors for cash, and the cash return back to SPE. The example is like Ford. Okay, Ford create a SPE. The SPE is a separate entity that buy the Ford's receivables or car loans, and these will be securitized, then sell to the investors for cash. The sales of receivables, there's two scenarios. One is sales with recourse, the other is without recourse. So the major difference is if a factoring arrangement or sales of receivables is made without recourse, the buyer or the transferee cannot ask the seller, the transferor, for more money if the receivables prove to be uncollectible. It is made with recourse, the seller or the transferor retain all the risk of bad debt. Because this actual protection for the buyers of the receivables, usually the buyer charge a lower factoring fee. There is always a trade-off. Okay. Let's take a look at this example, accounts receivable factored without recourse. We're given information the book value of the receivables was $600,000, which will be transferred to the factor bank. This is a transfer without recourse. And the factor immediately remitted to the transferor equals to 90% of the receivables. So the amount was $540,000. This represents the proceeds received from this transfer by the company. The remaining 10%, which accounting for $60,000. And this $6,000 actually will not be fully collected because of the sales return and allowance. The actual receivables may be lower. And the factor charge 4% factor fee, which is 4% of balance of receivable, $24,000. So this is the revenue for the factor earned as a fee. And the rest provide a cushion against the potential sales return and allowance. Since the potential sales return and allowance, the actual value may not be $60,000. In this example, the estimated amount was $50,000, which is $10,000 lower than the 10% of the book value of the receivables. This $10,000 actually is the additional loss of the transfer or sale, the sellers of the receivables. Here we prepare the journal entry. First, for sure, the company will debit cash $540,000. That's the amount of cash received from factor or from this transaction. And also write off this book value of accounts receivable by credit accounts receivable $600. The difference, $60,000 was actually accounted by these two. The first is a loss on the sales of receivables. The loss 34 actually has two components. One is $24,000 for the factor fee. This is revenue for the factor, but this is a loss for the transferor or the Santa Teresa Glass Company. Another $10,000 is actually the reduction in the value of the residual accounts receivable. The residual estimate value will be 50. After we subtract the factor fee, the $26 will be considered a cushion to protect the factors against potential sales return and loss. If the factor can collect all the receivables for $50,000, the $26,000 will be remitted to the Santa Teresa Glass Company. So this accounts is just in case there's any additional sales return allowance. And for the different scenario, if we assume the management just estimate the value of the residual accounts receivable is same as book value, okay? In other words, there will be no loss from the value reduction. So the loss from sales of receivable is only 24, just factor fee. And here will be $36,000 because this is 60. Again, the total is still $60,000. 24 for the factoring fee, 36 as a cushion or protection to the factors. The receivable factor with recourse, based on the definition, this recourse actually the seller, the transferor, retain all the risk of bad debt expense. So there will be extra liabilities for the seller. In that case is Santa Teresa Glass Company. Usually the factor will reduce the factoring fee. In that case was $24,000. This may reduced. Okay, to be simple, we just assume the fee doesn't change. Then let's see what happened. Keep the original assumption, the residual value, estimate value of receivable is still $50,000. Subtract the fee, that's the cushion. And the loss now has three components: $24,000 fee, $10,000 reduction in the value of accounts receivable, plus $5,000 additional. That's a recourse loss from the recourse. Here, actually, we just increase the loss by the amount of recourse and the credit recourse liability. See, all these two journal entries we made on the behalf of Santa Teresa. Which of the following is not true about the factoring receivables? The answer is the B. Transfer without recourse means transferee bears the risk. Other three choices are correct. Cash received upon transfer is less because there at least a fee, factoring fee charged. So the company must at least incur a factoring fee. Yet if there is a recourse, there will be a larger loss, additional loss. Transferor remove the factor accounts receivable from its balance sheet. That's correct because This is sales of receivables. Considering transfer of receivable as a sales, when the transferor allows to treat a transfer as a sales, when the company or the transferor has surrendered the control over the assets transferred. The condition we choose to consider is whether the receivables have been isolated from the transferor, beyond the reach of the transferor and its creditor. Each transferee has the right to pledge or exchange the assets it received because the transferee now is owner. Transferor does not maintain effective control over the transferred assets. So here, this is a flow chart. Finance with receivables. It depends on whether these conditions are met. If yes, this is a transfer of receivables or sales. And there's two circumstances: without recourse, with recourse. If these three are not met, no, security borrowings. In this text, we cover the pledge. All receivable used as collaterals. We didn't talk about assigned. This is for the specific receivables used as collaterals instead of all the receivables. But anyway, they are very similar. Also, for the transfer of receivables, the company should provide this information.